Good afternoon, everybody. Thank you for joining us on the call today. We are going to discuss, it's going to be a short call, but it's a call that we think is important. A lot of people are selling equity index annuities, fixed index annuities, and they're selling them with living benefit riders. And they're showing clients, they have roll-ups and guaranteed death payments for life, regardless of the account value. And it's at C.O.R.E, we do a comprehensive analysis. If we are brought an opportunity, we go out to the marketplace. We have tools to research and spreadsheet living benefit riders, to spreadsheet products, features, all of these things. And some of the things that have become apparent to us is that sometimes, just like when you're running insurance quotes for life insurance, the cheapest premium is not necessarily the best solution when all the factors are weighed in. And sometimes when you're doing a living benefit rider, the one that pays the most income is not necessarily always the best solution. And today we're going to explore that and discuss that there are other factors that should be weighed in, and sometimes the difference is quite compelling. We're going to talk about a real life case. This is a case that we worked on, and we were looking at a 10-year deferral, guaranteed income for life after year 10. We had a $390,000 initial investment. So we're going to compare what we think one of the finest products in this space is the MassMutual Ascend product with MassMutual's living benefit guaranteed income for life rider. And we're going to compare it to Company B. Company B happens to be one of the giants in the FIA in living benefit guaranteed income space. We're not going to identify the carrier. I'm not maligning that carrier. We use carrier B ourselves from time to time when it's the right situation. We're going to talk about income versus remaining value, liquidity versus and capital preservation. Look at the carrier profile. Look at the financials of the carrier. Look at their cap rate integrity. What do they do on their first anniversary when the cap rates are coming up? Do they stomp on them? Do they hold them up? What's their long-term track record? Talk about the products, mechanics, fees, and again, the cap structure, client decision framework, advisor recommendations, and key takeaways. So MassMutual Ascend versus Company B, it's a 10-year comparison of income, liquidity, retained value, and the carrier profile. Company B offers slightly higher income while MassMutual preserves significantly more value and reaches liquidity sooner. So again, another snapshot here. So MassMutual maintains a higher remaining value over time. So the year 10 account value at MassMutual is $339,950. At Company B, it's only $143,000. It's approximately $196,000 difference in year 10 account value. Company B provides slightly higher annual income. It provides $38,532 a year. MassMutual provides $37,544 a year. Basically a $988 a year difference, $82 a month. So the total extra income over 10 years is $9,880. MassMutual also becomes liquid sooner. It has a 7-year surrender period, so day 1, year 8, the surrender charges are gone. Company B has a 10-year surrender schedule. The core trade-off is modestly higher current income versus significantly greater retained value and flexibility. So MassMutual preserves more capital over time. Company B draws down faster due to the higher income structure. Liquidity comparison, year 8 versus year 10. And year 8 values at MassMutual is $368,000 versus $214,000. For clients who value flexibility, access, and optionality, the shorter surrender schedule and higher retained value can be meaningful. Many of our clients enter into these arrangements and they start off with, hey, this is what I want to do today. And they get 5 years or 10 years down the road and are like, wait a minute, my life's changed, my circumstances changed. I might want to change some things up. what are my options? So again, we're talking about a $988 a year difference. We're talking about a $339,000 account value in year 10 versus 143,000. So the client gains $10,000 additional income over the next 10 years, but gives up $196,000 in account value. That's a big difference. Let's look at the company's ratings and profiles. MassMutual Ascend is a wholly owned subsidiary of MassMutual, which is MassMutual Ascend has some of the highest ratings in the insurance industry today. MassMutual Ascend alone has $50 billion in assets, and it's backed by MassMutual, which has over $500 billion in assets. MassMutual is a mutual company. It is not a stock company. It is not owned by a private equity firm. They tend to be conservative, insurance-focused approach. They are looking out for the policy because the policy owners in a mutual company are the company owners technically of the company. So MassMutual tends to be looking out for their policy holders. Company B, ratings aren't so good. They do have $90 billion in assets. They're backed by KKR. They're owned by KKR, a private equity firm. Private equity firms right now are focused on higher yield and credit-driven approach. So, it used to be there were two classes of insurance companies. There were mutual companies and there were stock companies. And people would argue that the mutual companies are acting in their policyholders' interest. They have different ROEs as far as their investing strategies. They tend to be more conservative and more financially sound. Stock companies, they got to manage for the profitability and the gains of the shareholders. Well, now there's a third class, and it's private equity firms, and it's the fastest growing segment in the insurance industry. And you have private equity firms buying insurance companies. Why? Because insurance companies are giant pools of assets that they get to take over and manage. And one of the bigger trends in the insurance industry is that these insurance companies, particularly the ones owned by private equity, are piling private debt onto the balance sheets of these insurance companies as alt investments. And it's a potential crisis. If I had to choose between private equity, stock company, and a mutual company as far as what company's financials are backing up the products that we're putting our clients in, my first tier would be mutual companies. My second would be stock companies. Why? Because as publicly traded firms, the amount of transparency and disclosure they must provide to the marketplace is far greater than a firm that's owned by a private equity firm that's also putting private debt on their books. Just something to consider when you're looking at who's backing up these lifetime guarantees for our clients. So again, the comparison that we're talking about isn't just about income. It's also about the philosophy behind the product and the balance sheet supporting it. MassMutual has one of the most consumer-friendly annuity portfolios in the industry across all their products. They're rarely the number one option when we're spreadsheeting. They're typically number 1, 2, 3, 4, or 5 in what we're showing. And when you balance the whole of what they bring to the table versus there's some companies out there in the marketplace right now that are number one. I've never heard of them. And I've been in the business for 33 years. Like there's these companies popping up. And again, they're backed by private equity firms. And I'm like, I've never heard of them. Where'd they come from? And they might have $9 billion or $10 billion on their balance sheet. And they're selling aggressive stuff. It matters. The financials of the company matter. So let's talk about the mechanics of the fees and cap structure. So the income rider fee comparison, MassMutual charges a 1.1% fee based on the account value. The 10-year accumulated fee cost is $54,000. Company B charges a 1.2% fee based on the bonused up income base. So yes, one of the reasons they have a higher income is that they show a bonus to the cash value in the income base, right? And then they charge the fee so they put in, I think in this case, it's a 30% bonus, and they're charging the fee on the bonused income base, not the cash value inside of the annuity. And their cumulative fee structure is $71,000 a year over the first 10 years. That's part of the difference in the cash values. So it's also the cap and crediting comparison. Many of these FIAs that are offering guaranteed income for life riders, if you look at the cap structure, this particular product, the cap is 4.5%. That means that the most you'll ever do in the good years is 4.5%. Mass Mutual's cap is 9%. And the actual performance with a 10-year look back was 7.14% versus 3.4% look back on Company B. And Mass Mutual has, so we talk about cap rate integrity. If you look at companies, a lot of companies will use teaser cap rates in the first year of their products. They're not guaranteed for the life of the product. They're guaranteed to the first anniversary. And what they'll do is they'll come in and they'll stomp on the cap rates and reduce them down. And again, you got a 10-year surrender penalty. You're stuck at least for 10 years because the surrender charges are, 7, 8, 9, 10% in the early years. So you got a 4.5% cap rate in Company B and a 9% cap rate in Mass Mutual. Now, I will say just in the last week or two, they dropped theirs to 8.75%. But see, they drop it on the entire portfolio. They don't just drop, they don't have new money rates. So that's the other thing some carriers will do is that they'll do new money rates where they'll say, okay, on new money, we're paying this, but then then the way they do it is that they reduce the caps on the existing book to subsidize the cap on the new money coming in. And then next year, the people who got that new money rate, well, now they're in the old pool, and the carrier keeps coming out with and it's great because it illustrates well, right? That first year rate illustrates well. It's not guaranteed. Mass Mutual, you can guarantee 7.25% for 10 years at the cap, or for the first 7 years of the surrender period. You can guarantee that the cap won't change at 7.25, or you can stay at 9. And the other thing is that Mass Mutual has a long-term track record of cap rate integrity. They don't drop their cap rates dramatically, and they also, if they drop it on the new money, it's the whole portfolio. So, and if they raise the cap rates on new money, they're raising the cap rates in later years on the existing book, whereas many carriers have a new money rate and they raise the new money rate, but they don't raise the cap rate on the old book that they've already lowered the caps on. They don't raise them again. They just keep driving it down on the older the book, that they keep driving it down. Whereas Mass Mutual, if they raise their cap rates in the future, they raise it on the entire portfolio, existing business and new business. That matters. And just the fact that in this particular circumstance, you're showing a 9% cap with a 7.14% 10-year look back performance versus 3.4. That's why the year 10 account values are so dramatically different. It matters, right? I mean, yes, it's great that you have this guaranteed income potential, but it would also be nice if the product performs. And a lot of these, if you look at a lot of these FIAs with these living benefit guaranteed income riders, the account value goes to zero somewhere around years 11 or 12. And yes, you have the income stream for life, but you're locked in for life. You're not going anywhere. Mass Mutual, after 10 years, you could say, you know what, I want to go in a different direction. And you still have a substantial amount of the money that you put into the transaction, that you have the flexibility to go someplace else or do something else with that money. So even when the headline income looks competitive, the underlying fee mechanisms and cap behavior can materially affect long-term value. And in this case, it's dramatic, the difference. So what's the client's decision framework? If you have a client that absolutely needs every single penny of guaranteed income to come out of this product from day one, then you need to be, okay, so maybe Company B is the better solution. You're going to get that $900 or $1,000 a year more out of the product. You're just going to have lower remaining values and a longer surrender period. You're going to be locked in. So basically, when I looked at the Company B proposal, I said, this client's locked in. They're making a decision today. And yes, it's guaranteed income for life, but they're stuck with this decision for the rest of their life, whatever may come. Whereas if you look at the Mass Mutual, yeah, I'm giving up a little bit of income, but I'm maintaining a whole lot of flexibility and a whole lot of value for a whole lot longer. Eventually, the Mass Mutual also goes to zero, but it's at a much further time frame out. And again, in year 10, you still have the flexibility to go in a different direction. So advisor recommendations for conservative clients and clients who value flexibility, the MassMutual Ascend is a stronger fit. For clients primarily focused on maximizing income, they need every penny they can get today. You might take a look at Company B. MassMutual appears stronger for retained value, liquidity, overall flexibility. Company B offers a modest income advantage for clients committed to higher current withdrawals. So the takeaway, and I've repeated these numbers, I'm saying the same things over and over because, I have found that sometimes to emphasize the point, what spurred us to create this little presentation was as we sit down and we do these analysis, because we have access to all the top annuity carriers to make recommendations and to show it's just how glaring the differences are. And again, we don't typically focus on one company or push one company, but I will tell you that the MassMutual products, when you look at the whole package of what they have to offer in their FIAs and their MYGAs, and whether it's if you're just looking for pure accumulation, or if you're looking for guaranteed income for life, if you're looking for options and flexibility, the MassMutual portfolio is one of the finest in the business. They're never going to be number one on the spreadsheet. And if they are, you know what? It was just a lucky day. That's not their intent. But what they offer is a total value package for the consumer. And again, it's why are we pushing MassMutual? It's because, well, we identified as we've gone through this process over and over with our annuity resources that, wow, this one really does stand out, and we need to bring it to people's attention. Look, we still, and we run, and you need to understand, we will always run every option, every client, every time, and say, here are your best options. But if we come in and carrier A and carrier B are number one and number two, and MassMutual's number three, understand why we might be talking about MassMutual. We want to point out, here are all the options, right? And then, obviously it's for you and your client to make an informed decision as to which one's best. And we support it, and we're not telling you not to do Company B if that's what's in the client's best interest. It's just we need to see all the facts. So many of the presentations that I see are one-dimensional, and annuities can be just as sophisticated and complicated as life insurance, permanent life insurance planning. So that's why we've done the presentation that we've done today. As I said, it's a short 20-minute presentation. We'll open it up to any questions anyone might have. Just know that when you come to C.O.R.E for help with your annuities, we're going to do a full-blown analysis. We're going to look at the marketplace. We even make recommendations sometimes about products that we don't even have contracts with. And we're like, hey, here's the best deal out there right now. We don't have a relationship. Here's someone that we know that might have a relationship, or here's another resource you can go to get access to that product, because we want to provide the best solutions we can for your clients. And that's kind of why we did a little bit of a focus today on the MassMutual Ascend products. Something I'm going to keep talking about. Our annuity team will keep talking about. I hope you found it informative. And you need, whether it's MassMutual or anything, when you're doing this analysis and you're choosing FIAs with living income riders, you need to drill in a little deeper and look at the proposals. Look under current assumptions. Look under guaranteed assumptions. Look at the cap rates. Look at how it performs. Look at, is the rider fee charged against the account value, or is it being charged against the phantom account income-based rider, right? Those things all matter. So hopefully that was educational about some of the things to look out for. Ryan, do you have any questions?
Looks good.
Well, I appreciate your time. Again, meant it to be short and sweet. Hope you found it useful. We look forward to working with you. If you have any questions, please give us a call. Thank you for your time.